We are here with episode 3 of Money Talks with Rob and Frank. Today we're talking about interest rates. What are they? How do they work? And how do they impact you? Frank is a mortgage professional. Frank, I'll let you introduce yourself a little bit more.
Hey guys, my name is Frank. Hope you recognize me from previous 2 episodes. I'm a mortgage broker and the owner of Franklin Mortgage, the mortgage lending and brokerage company licensed in several states. And then here we are with Robert, have a conversation about money all the time.
Yeah. So the first question is, what is an interest rate and how is it determined?
Well, I'm assuming we're kind of talking about interest rates on the mortgage end or any consumer loans. So what we have in US, we have several benchmark rates that are used as a base to calculation of all the rates. So, for example, the Federal Reserve yesterday announced a reduction of a benchmark rate, federal rate, so it's an improvement. But in addition to that, in the banking world, we have other rates, which is called SOFR, S-O-F-R, which is the overnight rate. That's how banks lend each other. That's also overnight, 1 day, 30 day, 1 year, 10 year, 5 year, just like US Treasury. There's just different rates, but at the end of the day, the bottom line is when each loan product is designed, whether it's a mortgage, your credit card, your car loan, major construction loan, and all various financing, it always uses the base as that benchmark plus the margin. Every institution sets up a margin that they want to make on top of that bottom line rate.
But on a more simplified explaining, what is an interest rate?
Interest rate is an amount you as a consumer or as a borrower would pay on the principal balance that you borrowed as an incentive for the lender, which is a bank, to lend you that money to start with.
Okay, and so we hear like 5%, 6%, 7%. What is that percent applied to? Is that just how is it calculated?
Okay, so simply saying in the mortgage world, there are 2 types of loans: fully amortizing loans or interest-only loans. In a fully amortizing loan, the lender says, okay, I want this loan to be fully repaid in the period of 15 or 30 years, for example. That means, let's say you borrowed $100,000 on day 1, and then the lender says in 15 years, it's like what, 220 plus another 5, another 60, 180 months, which is 15 years. I want this loan to be gradually fully repaid. So every month with your monthly payment, I want you to pay a portion of interest and a portion of principal. So the way the first payment calculated is, let's say you borrow $100,000 and you need to pay an interest rate of 5%, that $100,000 divided by 5, multiplied by 5%, which is $5,000 a year, divided by 12, which is about $433 or something like that. So with your first monthly payment, you have to do $433. Then lender says, I'm going to divide $100,000 by 180 months, and this is the principal portion. So your first monthly payment is going to be your interest, which is principal times interest divided by 12, plus a portion of principal, which is your principal divided by the amount of total of month. Now we determine the first month. The second month, since we paid a small fraction of principal, that principal gets reduced for that amount, and the interest now is calculated on slightly smaller principal.
So on an amortization, you pay more principal in the front.
No, more interest.
Interest in the front.
More interest in the
which
front.
is what you owe for borrowing that money.
Correct.
And then the principal is what you borrowed that you're paying back.
And then of course,
then it offsets the more you pay off.
Yeah, or an example, the bank says, look, Robert, I'm lending you $100,000 with 5-year balloon. You're going to say, what is balloon? The bank is telling you, hey, let's say they say, we want to get paid 12% interest for the ease of calculation. 100,000 times 12%, which is 12,000 a year, divided by 12 months, meaning $1,000 a year interest only. They're saying, Robert, we're going to give you $100,000 loan with 5-year balloon with monthly payments of interest only at 12%. That means you're going to be making $1,000 a month each month, which is going to apply just an interest only. And the year 5, month 60, you're going to have to bring 100,000 principal and pay it in full.
Okay.
So it's a balloon payment.
Yeah.
We have ARMs, I mean,
And we have questions about the arms later.
Okay, all right.
Well, let's hop to the next question. How can interest rates impact buying a home? When they're high, when they're low, how does it impact a consumer buying a house?
You probably have seen during the COVID years, right post-COVID, when the interest rate dropped to the bottom line, which is a benchmark rate, was in 0.25%. Right now, the Fed's was in 5.25% and reduced it to 4.75. I mean, that's, as you can see, your borrowing cost at 2 or 3% mortgage versus your borrowing cost at 6-7% mortgage is literally double, meaning that your monthly payment on a same house, same purchase price, same down payment would have been twice higher, with the interest rate being the double what it used to be. So what it really means to you, because guidelines haven't changed. Guidelines are still telling you 50% debt to income ratio. You haven't started making, I mean, I wish we all made twice the amount of money, then it would have it would have leveled off, but it's not the case. So if the individual only increased a small, change to her income, but the cost to borrow this for the same home is double, the debt to income ratio would simply not going to work. So either that individual would have to provide a substantial down payment to meet that requirement, or wait until the rates improve, but
or buy a cheaper house.
Buy a cheaper house, or there are rate buy down options as well. But once again, there are, well, we can go. I said I'm jumping a little bit. So let's stick to
absolutely. So, and that actually brings us to the exact next question, because I assume you might touch on that. What can a consumer do to get their rate lower? What are just some things that, if their interest rate is higher than they thought and they want it just a little lower? Okay.
So there are three major, in the mortgage world, there are three major options I've been seeing recently. Option number one is let's say there is a lender who tells you, well, your par rate. Par rate, it means that the rate that you would be getting based on your criteria without having to buy down anything. So let's say the rate is 6.5%. The lender says, look, you have an option to buy down the rate to 5.5%. So that 1% buy down is going to cost you 2.5% of the loan amount. So now you start thinking, okay, so I have to borrow at 6.5 today, provided that you do. But then you're thinking, Federal Reserve has made an indication that in the next 2 years, they're planning to reduce the benchmark rate for 2.5% more than they did. So technically, in 2.5 years, that 6.5% loan would be 4.5%, and it would be a really good time for you to consider to refinance. So 2 years. So imagine you have to pay, 2.5% today to buy down the rate for 1 point. You will not be, you're just not going to break even.
Yeah.
You're just going to spend, and the other issue is that you have to bring 2.5% cash up front.
Yeah. So you think sometimes, if the rates are already like bottomed out level, that would be probably a good time.
But nobody knows when is the bottom, and it's hard to targeting. The issue is remember, there's a global issue. The rates are directly tied up to economy. If economy is overheating and the money is way too accessible, inflation goes up. So that's Federal Reserve steps in and says, hold on, we need to cool this off. We need to make funds a little bit more expensive, so the consumer spending go a little bit down, people spend less, inflation goes down because there's not much to buy. That kind of a regulatory thing that they do all the time. Because inflation it correlates to many different things, but government really tracks down unemployment rate, because unemployment is a good indication where economy stands today. And then that's one of the reasons why rates went down, because for 2 consecutive months, the projected unemployment or projected creation of jobs have not met what they thought it would be. So they said, okay, if let's say we want to create 230,000 jobs in one particular cycle, but it's only 150,000 jobs were created, that means the economy is laggish. It's not getting to where it needs to be. So Fed step in and say, okay, this is the time to ease up a little bit. And one of the things they're easing it up with is the rates. So meaning that more money into the market, more growth, more spending, cheaper money, more spending, better economy.
Yeah.
And opposite of the same thing, and that's the reason. So meaning that when we see the rates improved, guys, it's not an indication of good economy. the improvement of the rates is an indication that the economy was actually heading in the wrong direction. And Feds want to prevent them to going to that direction completely. And that's why they're easing up the rates now to prevent that from happening.
And talking about rates, what is the difference in between fixed mortgage loan and an adjustable rate mortgage?
Right. So fixed rate meaning the term of the loan. Let's say you sign up, let's say you're borrowing today at 6.5%, for example, and 30-year. So for the 30-year period of time, that interest column that we discussed will always be calculated based on 6.5% rate. Adjustable rate mortgage, most popular, there are 3, 5, 7, and 10 years adjustable rate mortgages. They're currently tied up to so-called SOFR, which is SOFR, which is an overnight rate kind of thing. It's the same, one of those benchmark rates. It has a benchmark rate plus margin. So if benchmark rate goes down, you may actually end up benefiting from ARM loan in 3 years. Let's say if you borrow, it's not that many 3-year ARMs today. They're mostly starting 5, 7, 10. But imagine you said, okay, you know what? I'm going to borrow today at 5.5%. I don't want to refinance. I want to sit tight and get this mortgage. There's not much benefits today. It used to be that ARM rates used to be much lower than fixed rates, but today they're very leveled up. But provided that they aren't, and if you say, I'm going to bet on it, it's a small bet, meaning that in 5 years, let's say benchmark rate from today's 4.75 goes to 2, and the margin will become on top of it is the same. So all of a sudden, your mortgage payment actually will drop on year 5, just because. Or opposite, if benchmark rate suddenly goes through the roof, and not 4.75 but 7.75, all of a sudden your mortgage rate will jump just because you reached that 5. Because the initial 5 years, 7, 10, it's the initial term when that interest is going to stay fixed.
Yeah.
But after that, it's going to start adjusting either every 6 months or every 1 year, depending on the loan term.
Okay, very interesting. So right now rates are cooling off a little bit, but 6 months ago they were really high.
Yep.
Was people still buying when interest rates are high, and is it a good decision to buy when interest rates are high, or should you just wait?
That's an excellent question. So October 2023, the conventional average interest rate hit the record. I think it was almost like 7.5% average conventional loan in the nation. So it didn't stop people from buying. Yes, it cooled off the market significantly. But imagine a very simple theory. Somebody needs to sell in that market, and then rates are so, depressing. That means if the rates were low, if that person would have listed, it would have had 40 offers.
Yeah.
When the rates are high, they barely maybe had 1 offer or 2. So as a buyer, you have a tremendous amount. If you're ready to exercise, meaning that you think to yourself, okay, you know what? I couldn't borrow at 4.5. I need to borrow at 7.5. How am I going to compensate my decision to do that? Well, by negotiating the price. So you're going to say, you know what? In 2 years, I'm probably going to refinance that 7.5 year loan into 4.5. So for 2 years, I have to pay 3% extra for my interest. So let me make an offer to the purchase, considering that I'm going to have to overpay for the next 2 years. So negotiate the price by, cutting off that 6% that you think that you may overpay for the next 2 years. And if the seller does not have too many offers to choose from, he or she may end up choosing your offer and say, that it is what it is at this point. So that's a benefit, less buyers. So that means that you are now the commodity. You're the golden guy. You're walking out with
you're the hero.
You're with that pre-approval is your golden ticket. You just, So that's a good point. On investor loan, it's just, in fact, my investor purchase buyers probably put a record for this during this time, because if previously they used to compete with regular homeowners, regular homeowners are out, investors are saying, you know what, I'm going to be the guy who comes in and negotiates with the seller today. It's okay, I'm going to borrow at a little higher rate, but guess what, it's not that they're living in the property is still getting, the rent is still getting paid. So if they put 20-25% down, but the tenant's rent is covering all the debt. So what they are sitting on, they're saying, you know what? In 2 years, property values would appreciate. Meanwhile, I'm going to refinance this debt. Meanwhile, it's basically like this. If this is your rent and this is your cost of borrowing, the rent in the next 2 years will go up, cost borrowing will go down, and the margin in between spreads out. So now, even though they entered on the break-even point, in next 2 years, average investor is projecting to receive $600, $700, $800 from the same property. Those is barely breaking even today.
Yeah.
So it's just a projection how you plan.
Yeah. So when people are refinancing,
Yeah.
and if you have rates in the 7s or 8s, right now is a great time to refinance.
Oh yeah.
What is the cost of refinancing, and what are the different types of refinancing?
Yeah, that's a deep question. Okay, so if somebody has a rate in the 7 or 8s, today we're seeing rates in the 5s. In the 15-year loans, we're seeing rates in conventional, and both FHA and conventional, in the 4s. So technically, I was talking about it with one of the clients yesterday. If you take a 30-year loan at 7.5% and refinance that loan into a 15-year in 4.5%, your monthly payment on $300,000 loan is like $200 difference. So you cut off half of your term, half of the lifetime interest, and then pay off your loan in the half.
Yeah.
So, but
and that's rate.
that's exactly that's what the rate does to you.
Yeah.
I mean, it's just a silly. Consider rate as how much money you're willing to throw away to borrow that X amount of dollars.
Yeah.
Because interest is something you pay and it's not coming back. The only incentive is the tax write-off, but as a homeowners, we still have actual bills to pay. Not always. Tax write-off is not always the only objective. So, but speaking of the conventional loans, if you're already below 80% loan to value, or even if you're considering to jump onto that category to get rid of the PMI, that may be a good option to refinance now.
How much does it cost to refinance?
Okay, so if we're looking at FHA streamlined refinance, there is no requirement for new appraisal. There is no requirement for no verifications of any kind. So there's going to be nominal, maybe. In fact, I'm seeing that it's going to be that you're going to usually you bring to closing your following monthly payment, but because you skip 1 month of mortgage, it becomes that you brought the following month mortgage payment to closing. You skip that payment because you didn't have to make, and from the month following the next month, your payment is going to be lower. So technically there are closing costs, but we try to fit them in. The only thing in the areas with a higher escrow accounts, meaning that the taxes and insurance are higher, because right now that's the time of the year where because when you refinance one loan to another, escrow balances are not transferable. You still need to replenish the new loan's escrow balance, while the old loan balance is only going to get released to you after the loan is repaid.
Oh, okay.
So you have to be prepared to bring that cash to close. For example, let's say imagine this way. You have a property taxes due in November. Today's September. On the refinance, they're going to tell you, look, we need to pay your taxes for you. So you're going to have to bring out of pocket the taxes for the November. Yes, after the closing, the old loan lender will send you the check back, because they're not going to be able to use that escrow because the loan is gone. Same thing with insurance costs, but for the new loan, you may need to bring those. So this is your probably the biggest closing costs I'm seeing. Everything else can be built into the new loan, because what happens is when we look at the rates, we always tell the borrower, saying, look, here is the bottom line, par rate.
Yeah.
The closing cost, if you're prepared to bring a little bit on top, it's going to be the bottom line. You're going to have to bring the closing cost, which is a new mortgage recording cost, title insurance cost, maybe new appraisal if needed, and et cetera, et cetera. Then the borrower says, you know what, I'm good, I want to have a bottom line.
Yeah.
Or the borrower may say, look, Frank, how can I get my closing costs compensated a little bit? And we say, look, this is a bottom line rate, let's say 5.25. You may accept the rate in, let's say, 5.75, which is going to create, that half a point is going to create about 1.5% lender incentive that can help you to pay for the closing costs.
Okay, so there's refinancing where you're just dropping your rate. And then there's also refinancing where you can cash out.
Yes.
And that's if you have, correct me if I'm wrong, 80% loan to value paid.
Correct.
So where 20% of your house is paid And
More than that, we have to arrive to that amount.
oh, you have to arrive to that
after
amount.
the
So
cash,
you really
after
need
the cash
like,
out.
you need to be below.
But
that.
remember, right now, it's about $16 trillion is built in the homeowners' equity in the U.S. There are people that are sitting in so much equity, accumulating high interest debt, credit cards, because it's a mental thing. Record amount of people refinance their loans in 3s and 4%.
Well, then, I think the reason it's a record thing is because it's easier to swipe your your credit card than it is to.
No, but also true. But remember, so many people are just not. I'm an Excel guy. Microsoft Excel is where I live. So I say, okay, look, you have a $300,000 mortgage at 2, 3, 4% interest rate. People think that they're just going to freeze that loan and never touch it again because they will never get this loan rate back. Great, good choice. Meanwhile, there is a 18, 20, 24% credit card loans that they're paying, and 20, 30, $40,000 balance in it. It's well exceeds if you decide to do a couple of things. You can always, if the credit is still good, hopefully, because the payments on credit cards need to be made timely, but also remember, if the balances are way high, 90%, 80% of utilization of the limits, it started hurting. The credit score will go to 600s, maybe low 600s. Will make that, once again, ineligible. So we have options. Let's say if your debt has increased, you can do 3 things, right? Thing number 1 is a cash out refi, meaning that you can take the cash out from the home, consolidate all of this high interest rate debt into a new loan, which comes at 5.5%, 6%, whatever. Yeah, you're going to make 1.5% extra than your current mortgage is.
Yeah.
But you're going to pay off, debt in the mid-20s, which is, to me, is like...
No-brainer.
It's a no-brainer because Feds are saying in 2 years we're going to reduce the rate again. So why? So you want to wait for 2 years, pay 24% a year, 48% a year, just to wait for them to reduce it for 2?
Yeah.
Hold on, guys. It's just a math that needs to make sense. It's number 1. And number 2 is the HELOC options, which is and second mortgage options. They're also very much available today, guys. Just if the credit is there and income is as good or as it used to be at the time of the origination of the original loan, you're very likely going to qualify for second mortgage or HELOC products, which your banks may say no to you. But once again, hear what your bank says and call the mortgage broker to see if what bank says is the only option. Never leave it as your only choice. So always verify if there is an option.
Yeah, and the last question we have today is, what are the rates right now, and what do you think is going to happen?
The rates, as I said, 30-year fixed, and with 20% down, we're seeing conventional rates in the 5s. FHA rates are in the 4s. Remember, the private mortgage insurance, let me correct myself. There is not too many people who's going to put 20% down an FHA loan. It doesn't make economic sense. So 3.5% FHA loans will probably priced out on a rate equal to 80% conventional rate, more or less. However, with the private mortgage insurance on top of the FHA payment, that's going to probably exceed the total conventional loan, in addition to the fact that, you didn't put 20% down, so your principal is higher, so you're paying a higher mortgage payment. So I would say target area for any home buyer today is going to be 5s to 6s, low 6s. Low 5s to low 6s, anywhere in that category. And where the rates are going, the rates are going to improve. But it's also the matter, as you said, we're going back to the same thing. Oh, I'm going to wait till the rates are going to go to the bottom.
Yeah.
Yes. Then you're going to go and you're going to be bidding for the same home with 40 other offers.
Yeah.
Okay? So now you're going to overpay for the home way more than that 1 or 2% that you're planning to pay.
Well, and I know in my hometown, during COVID, when the rates were in the 3s, people were paying $30,000, $40,000 over the asking price, which was right at the max of what that house was worth, and still weren't getting homes. They were offering that much, and guys, these are on like $200,000 homes. So they're offering like huge percentages over what the house is worth, and still getting told no. No,
and today, let's say if your local developer, your local builder is building the homes, they are just like all of us. They're sitting in expensive construction loans. They can't wait to get rid of that home. So it's an opportunity for you to walk in and say, hey, I'm looking for the most incentive you can offer me now.
Yeah.
And then they're going to throw financing incentive, rate buy down incentive, move-in incentive, options incentive, and then take advantage. Yeah, I know you think that, I'm going to wait for that bottom line. When it bottom line, that the same developer is not going to have an inventory, and if he does, he's going to give you zero incentive. You're going to be in line with everybody else for whenever the home's are ready. It's just we always like to say pay for the convenience. I would say this rate situation has created a convenience for those of you who look at it this way. Because if waiting, okay, put aside the waiting, 2 years of waiting, $2,000 a month in rent, it's $50,000 pay in rent, waiting for interest rate to drop. Once again, you could have spent that $50,000, of which probably $15,000, $20,000 would have gone to principal instead of to your landlord's pocket.
Yeah.
Once again, home ownership is still going to beat renting every and each time. And
Plus interest.
plus
appreciation.
Plus appreciation, exactly. Rates are going down, more demand, prices going up. So you haven't done much. You just paid your mortgage, market did good for you, and then you did good for yourself.
Absolutely.
It's a win-win to me. And then even the interest rate may not be as you think ideal or perfect yet, and we may think we need to wait for 2 more years, guys. In 2 more years, I'm afraid that
there's always tomorrow, and people always say, "Oh, I should have bought then." And the old saying goes, "The best time to plant a tree was 10 years ago, and the second best time to plant a tree is today."
Correct.
So,
no, but I said, I haven't, from any of my clients, none of them ever told me, "Oh, you know what? I should have not bought that home 2 years ago. I should have bought it now."
Yeah.
I've been doing it for 8 years. Not a single client ever told me that.
Yeah.
Everybody says, "I should have bought the home 2 years ago, not now." Yeah. So if that's what I'm hearing, I guess majority is right, always.
I agree, Frank. Well, hey guys, as always, make sure you drop a comment, like, and subscribe to us, please. If you guys have any questions, drop them down below. We'll love to answer them and get back to you. Thank you guys very much, and appreciate you guys listening.